Hello, I'm Don Gould, President and Chief Investment Officer of Gould Asset Management, and I'm pleased to welcome you to this call today, where we will touch on some of the topics that we covered in our quarterly report to clients. I hope this call finds you and your families and loved ones all doing as well as can be hoped under these challenging circumstances. I'm going to talk very briefly about the economy and just some very general high-level thoughts on things. Then I'm going to move more specifically into some charts that will enable me to discuss a little bit about the stock market as well as the economy. So let's start with the economy. I'm not going to review everything that you read every day in the paper. I'll just simply say that all you have to do is pick up any newspaper to see just the immediate damage to the world economy from the lockdown, which has just been simply breathtaking. I don't think there is a household on earth that has not been directly affected by this. The longer the lockdown continues, the more widespread the effects will be. So even those who have been insulated might not be if this stretches out a lot further. And frankly, that's the bad news from this report today. Very brief, because again, all you have to do is pick up the New York Times, the Wall Street Journal, or any other publication, and you can see what the economic news is. You can also drive down the street and see what it is. But there is good news that I think is a little bit more behind the scenes. And the good news is that there's a tremendous amount of work going on behind the scenes, both in the United States and globally, to figure out how to shorten this lockdown period. And I would break it very generally into two categories. First would be on the scientific front. We know there's all kinds of things going on to try to identify treatments that will be effective in treating people who are already infected in order to lessen the severity of the illness. We've heard about the one from Gilead, which showed some promising first results in a test in Chicago. We're waiting for more formal clinical trials on that one. We know there are many other companies and government agencies around the world that are working on similar kinds of treatments. We think if an effective and widely available treatment were to be made available soon, that would really be a game changer in terms of accelerating the ability to shorten this lockdown. The second area where there's intense work going on, of course, is on developing a vaccine. We've heard 12 to 18 months as the standard number being given for how long it takes to develop a vaccine, even under good circumstances. But we've also heard that some vaccines will be in trials as soon as the summer. So, of course, a vaccine would be the ultimate way to address the lockdown and to be able to allow people back out into society safely. Okay, I'm now going to go to some charts. First chart here is the S&P 500 US Large Cap Stock Index 2020 year to date. And what you can see is that after hitting a peak in mid-February, and this is an all-time high, by the way, the index fell all the way down to March 23rd. And over that period, it fell about 34%. So a very, very sharp and substantial drop. Since then, up to this point here, which is the recent high just last week, the S&P 500 had recovered about 55% of this full decline here. Interestingly, because it represented a gain of more than 20% from down here, we're technically in a bull market. Obviously, it doesn't feel like a bull market if you were here in mid-February and you're here now in mid-April. But believe it or not, technically we're in a bull market. Currently, we're down about 15% from the beginning of the year to right here, which obviously is not pleasant, but it's not cataclysmic either. From our viewpoint, the market has held up remarkably well. I don't think anyone should be surprised, given the economic news, if the market continues to be quite volatile, and we shouldn't be surprised if we see downside volatility. There's just too much uncertainty out there right now for anybody to really feel confident about what the short-term outlook is for the stock market. But as we constantly remind our clients, we are not short-term investors. We have long-term horizons. And if we keep those long-term horizons in mind, it makes the direction of the market's next move much less important. Okay, I want to take a look at one of the many charts from our quarterly report. And if you would like to see the full report, of course, clients were sent them. We also have the report available on our website if you click on the blog link. So here's a illustration of the importance of certain sectors in the economy, measured three ways. One in terms of GDP, one, so that's up here, one in terms of payroll in the lower left, and then one in terms of percentage of S&P 500 operating earnings. The sectors we're looking at, easiest to see here on the right, retail, and by retail we mean things like shopping centers, malls, think Macy's, think Nordstrom, restaurants and bars, entertainment, that would be everything from movie theaters to concerts, airlines and cruises, hotels and tourism. And so these colors also map to the other two charts. So if we start here in the upper left, you can see that these industries combined account for 19% of GDP, 19% of the economy in effect, from these industries, which are the industries that we all would view as the most vulnerable to the lockdown. They're the most people-facing industry sectors. If you look at employment, these industries accounted for, prior to the lockdown, accounted for about 20% of all the jobs in the United States. If you look up here, the industries accounted for only about 7% of operating earnings. Now, the reason that the earnings percentage is so much lower than the percentage of GDP or the percentage of payroll is that these are lower margin jobs, lower profit margin industries, I should say. And that might go somewhat toward explaining why the stock market has held up as well as it has, because certainly there are businesses that are doing surprisingly well in this environment that account for much larger portions of S&P 500 earnings. Nonetheless, it's important to note that these are not the only industries that are suffering job losses. There is a multiplier effect. As people lose jobs in any industry, it has a knock-on effect into other industries, and we're seeing no industry is immune, whether it's healthcare, whether it's government, whether it's technology, whether it's professional services, law firms, accountants, everything is impacted by this. The other chart I wanted to focus on today is this one. Oil has been in the news quite a lot lately. You can see here, this is a chart of the price of West Texas Intermediate crude oil going back to the start of the century, the millennium here. You can see it got as high as about $145 in 2008. And as of March 31, the end of this last quarter, it was down to $20. And since then, it's plunged further, depending on what day and what time of day you look at it. Last couple of days, we've seen it between $9 and $13 a barrel. You probably also saw the news about negative oil prices, another anomaly that we can add alongside negative interest rates. Oil prices are not truly negative. These were the prices of oil futures. The problem is that the demand for oil, specifically for transportation, whether driving or whether flying, has obviously pretty much fallen off a cliff very, very suddenly. The demand for oil in the United States is down on the order of 25% in the last month. And the supply of oil can't actually be turned off as quickly as demand, it turns out. And so what we have is a storage problem, which led to this remarkable anomaly of where people were actually paying somebody else to take their oil. And that was because there's a shortage of places to store the oil. But in fact, the real price of oil is not zero. It's not negative. It's positive, but it's very, very low. And you know, I show this chart for two reasons. One, it's just in a microcosm. It shows you the impact of this economic downturn on the price of a commodity, which in turn is reflective of the impact on the whole economy. But the second thing is that oil, although, you know, historically we would say that a drop in oil prices was good for the consumer, given that the consumer is doing very little driving and very little flying right now, there's almost no benefit right now. There might be in the wintertime in terms of heating oil, but basically we're not going to get a big benefit from this drop in oil prices. On the other hand, there is a big economic drag because energy industry employs a tremendous number of people. And as the price of oil goes down, it affects not only the drillers, the refiners, the firms that transport fuels, et cetera. And it's a very large source of employment around the world. So this is just another impact of COVID and the lockdown. Okay, I'm going to stop it here. I thank you for taking the time to watch this today. And of course, again, feel free to go to our website, gouldasset.com, where you can see our entire quarterly report. And again, we wish you all the best of health and safety.